Good morning, students and friends. This is Chris Wager with the Central Asian Productivity Research Center. Welcome back to our spring lecture series. I'd like to introduce Dr. John Collaros, who will be our host today. John is the founder of Ariston University. John, take it away.
Thank you, Christopher. Hello, everyone. As you know, my name is John Collaros, and you have seen me with previous presentations, and I'm going to address two important things today. First, I want you all to know what my role is. And second, I will introduce the speaker. As far as my role, it is that of a facilitator. I'll be looking at your questions and bringing them to our speaker. Basically, that's the main function that I perform. But it gives me a distinct honor and pleasure to bring to you folks today's speaker, a distinguished financier, someone who has graduated with a master's degree from one of the best universities in the world, the University of Chicago. But it's not only his education that makes him distinct, it is also his practicing as a financier. He has worked with some of the best and largest companies in the USA, like Standard & Poor's. But the most important thing about our speaker today is that he has started a risk analysis company along with a few other companies. So he's not just a theorist who knows the subject, he has also practiced it. So with someone who has started 6 different businesses of his own, has practiced finance, I think is the best speaker, the best person to address the issue of financing today. And with that, Mike, the floor is yours. Thank you.
Thank you, John. And throughout the presentation over here, morning for us, evening for you, please feel free to ask any questions. It's my strong belief that the most value of these presentations is, in fact, the degree to which we can establish any dialogue back and forth and answer your specific questions as opposed to just my reading off of slides for you. But as John pointed out, our topic here today is in fact finance, and there's really 3 concepts we'll be trying to cover. Some basic finance definitions, and the definitions I think are the most important aspect, what we can try to accomplish this morning, given that to study finance in its totality obviously requires a good deal more than what one could possibly do in an hour or so chat this morning. People spend years and years and years studying it and applying it and not really knowing what it is. So we're just going to assume that you have some finance background and go through some applications over here or a case study to see how these definitions really apply in a real world situation for a case study I've put together over here, just to put together like an example of what some of the terms mean. And then also we'll be covering very briefly, what is financing all about? Because finance and financing, they are obviously related to one another, but in many cases, what individuals such as yourselves here this evening are interested in is, how do I finance my business, which is really the topic of financing as opposed to finance. So to start off with, what are the definitions of finance? What does it really mean? Well, if you look it up through various textbooks, you'll find quite a few of them. And the reason for that is because finance as a concept, it dates back about 5,000 years. The earliest records of financial activity, of finance activity, it dates back to about 3000 BC. So based upon that long history, finance currently encompasses a wide variety of activities. Those activities really associated with the sourcing and usage of money. We'll be discussing later how it differs from accounting, because the finance really applies to the activities associated, not necessarily the metrics or the recording of it. And the management of money also includes activities such as investing, borrowing, lending, budgeting, savings, and forecasting. And that last word is really the heart of what finance is about, because it's not just understanding a P&L retrospectively, but understanding the risks and opportunities associated with the business as measured by a P&L looking into the future. Because ultimately what it's about is to raise or to provide funds or capital for an ongoing operation of the business, be that for a startup, be it on the consumer sector or the private sector itself. And with that, should note that the application of finance really falls into four basic categories of finance. We'll be focusing today primarily on the corporate side, or what finance means for business. The principles we'll be covering and some of the definitions, they apply equally to the public sector or the government sector, for personal finance, and also for nonprofit. The big distinction between these four categories is what are the objectives itself. In corporate finance, the objective is really to ensure that an ongoing business has the funds required to conduct those business activities on a daily, weekly, monthly, and yearly basis. Whereas the objectives of public finance, personal finance, and nonprofit finance are slightly different than that. But that's beyond what we're going to be covering here this morning. And John, I'll stop for a second. Is everything in place in terms of you're receiving questions from the audience here?
Nothing yet. It's a kind of early. Usually the questions come in after the middle of, half the presentation.
Very good.
Towards the end. But you're doing an excellent job, very plain, clear, and to the point. Thank you.
Okay, just wanted to check in.
Sure.
Beyond the applications of finance, there's additional practices that are included with such advanced techniques such as publicly traded stock pricing, option pricing, publicly traded bond pricing, initial public offerings, the financing for those, and the securitization of assets themselves. All of these are specialized fields unto themselves. People spend years training in the schools and universities to understand the mathematics behind each of these applications and techniques, but and as well as spending years developing the proper networks to accomplish these particular activities. We're not going to be delving into these into any meaningful fashion this morning, but I put them out there just as additional terms that you should understand. One thing I want to put up front, just because our audience is both people in the Western cultures, and some of you may be based in countries where Islamic principles are more established, because there's a fundamental difference in the terminology between the West and Islamic countries as it pertains to some of the core features of finance. I should say, in Western accounting, we have loans and interest charges. Whereas in many Islamic countries, loans and interest are not allowed in business transactions. That doesn't mean that finance doesn't occur throughout the world, including in Islamic countries. That's because even when loans and interest are not allowed, things are structured that there still are providers of capital and costs for working with capital from these providers. So the financial principles that we'll be discussing and terminology apply in both situations. When partnerships with capital providers are structured on the basis of a loan and interest for those loans, as it is in the West, or as it is in many Islamic countries, where the provider of capital has more of a quote unquote equity position and they share the risk with the owners of the business, but at the same time, there's cost associated with the owner coming from the providers of those capital. And I'll try to be using terminology that is loan and interest versus capital and cost neutral throughout the presentation. But you can somewhat subsidize that terminology. In the West, it's loan and interest. In Islamic countries, it's capital being provided and costs associated with those providers, additional costs. Another distinction that's important to understand, because the general public gets it confused all the time, that finance and accounting are one and the same thing. And that's really not the case at all. because accounting is much more limited in its scope in that it's really all about the recording of financial transactions pertaining to a business. Accounting includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, tax collectors, and shareholders. Whereas finance is the management of money, including activities such as investing, borrowing, lending, budgeting, savings, and as I mentioned before, and you'll see why, forecasting. In very simple terms, I like to think of it as accounting records the past, what has actually occurred in a business, whereas finance plans for the future, which entails understanding and evaluating the uncertainty, or as we often refer to it, as the risk of an organization itself. And this risk factor or uncertainty is at the heart of what finance is about, because inevitably in a business setting, in a corporate setting, any P&L that you put together to represent what's going to be happening in the future, there's risk associated with it. And what happens is that the greater the risk or uncertainty over the timing or of the amount of the investment will be repaid, the greater the cost of the sourcing of the capital. So if I were to, quote unquote, in Western terminologies, lend John $100 for 1 hour, he might say, Mike, the interest rate for that 1 hour is 0. Just give it back to me an hour from now. It's too small for us to bother with. I'm 100% sure 1 hour from now you're going to repay me. If, however, I said, John, give me $100 and I'll pay you back 2 years from now, John's going to sit back and think, well, 2 years from now, will Mike be alive? Will I be alive? Will I still know Mike? Will I be able to get a hold of Mike? Will Mike remember that he owes me the $100 to repay me? So for that transaction, John, rightfully so, would be asking himself, what additional are you going to give me beyond that $100 when it's time to repay me, pay me? And in a 2-year time period, he might say, sure, I'll give you $100 today. You give me $20 back additionally for the cost of my providing the service to you in 2 years. So that has an implicit interest rate then of 10%. So if it's 1 hour away, John might say no interest, no cost for that money. 2 years from now, he's going to charge 10%. If I were to say to John, give me $100 today and I'll pay it back 20 years from now, John's going to go, my God, 20 years from now, what the heck is this guy talking about? Will we know each other in 20 years? Will he be alive? I be alive? The same sort of risk, but now it's multiplied 20-fold, 20 times greater. So he's going to be looking for a much greater payment for his services of providing that capital to me over the course of these 20 years. And he may be asking for a 20 or even 30% interest rate per year. So the greater the uncertainty, the greater the cost associated with the sourcing of the capital itself. And what are the types of uncertainties that impact the timing or amount of investment that will be repaid in a corporate setting? There's a wide variety of risks, but the number one on the list really is inadequate cash flow on part of the business enterprise to repay whatever additional investment was afforded to them. And we'll be spending a good deal of time evaluating how to measure the cash flow and how it is very, very sensitive to what assumptions or what information goes into the future forecasts. But there's quite a few other risks that'll impact the amount that'll be repaid or if it can be repaid. Management fraud, this is especially true with new company startups where you may not know the owners of the business or the operators of the business very well. Are they ethical? Will they be providing you with good information, or are they simply looking to take the money and run? Changing government regulations. In the US, this is an ongoing source of frustration with corporations where the rules governing how their operations can occur in the US changes over time. The rules that were in place 5 years ago aren't the same as today, and they're not going to be the same 10 years from now. It's not that the regulations are necessarily good or bad, it's just that they represent a risk to the organization's cash flow and the operations of that business and its ability to repay for the loan itself. Other risks are unforeseen legal liabilities. Are we engaged in a highly risky operation where there might be lawsuits, past, present, or future, that could jeopardize our ability to repay? And finally, there's a whole slew of risks associated with the future of the economy itself. Will the economy go into recession? Will the economy be in a boom situation where the business will be supply chain challenged, where they can't source the products to actually sell to the consumers itself? So on that, let's delve down a little bit more in terms of what the uncertainties impacting cash flow actually are, because they fall into two broad categories. One is on the revenue side, how much income the organization can be expected to bring in. And if they're less than expected, it represents great risk to the organization. As I mentioned, these could come from economic recession, could come from lower consumer demand for products or services, and this could come from competitor discounting, could come from limitations within the organization itself on their sales due to supply chain and disruptions, which is occurring throughout the world over the past 12 months and is likely to continue over the next couple of years. Less than sales can also come from the fact that there's new entrants into the marketplace. New competitors are constantly springing up in Western economies for providing identical services. If entrepreneurs see someone succeeding with a particular product or service, lo and behold, that organization can expect or should expect within a year or two to see competition, new companies coming into the marketplace, trying to provide the same products and services that they are. Somebody opens up a new restaurant on a corner of an intersection and everybody knows that they're doing quite well. Lo and behold, it's not at all a surprise if a year later, 2 years later, another restaurant opens up across the street because they know, hey, this is a good location. People are coming to see Joe's Diner across the street. Well, worst case is maybe I'll get from the get-go 40% of the customers going to Joe will come over to my location to see how much better I am than Joe is. So I'll have a much safer opportunity to start up a restaurant business. But again, one of the biggest issues with respect to risk is just fundamentally bad financial planning of the revenue forecasts. Because any good financial planning of the revenue forecast should include an assessment of each and every one of these risk factors for the revenue side. What happens if there's a recession? What happens if there's lower demand for the product or services? What happens if competitors open up next to me? All of these should be evaluated in the context of the financial planning and what impact it'll have on the revenue forecast to do a what-if analysis. Similarly to the revenue side, there's a good deal of risk associated with the expense side. And these, why are equally important, in some way, they're a little bit better to plan for because typically business executives have much more control over the expense side of things. Things like supplier price increases or labor cost increases, to a limited degree at least, business executives have the ability to manage these and control these, at least on a short-term basis for the next year or two often, in that they can lock in their supplier costs for a short time frame. Whereas in the revenue side, most of the risks associated with the revenue side are things completely outside the control of the organization itself. Whether you're a small company or you're a Google, if there's an economic recession, you're going to be impacted by that, and they have very little ability to alter the fundamentals of what's causing the economic recession in the country itself. So let's go through some of these concepts in an actual case study example over here this morning. And I've put together a set of numbers for us to review for, let's call it a restaurant or gelato store that would be opening up on a corner over here, and what's required from the business owner to get the business up and running. For the example, we're going to be assuming that he needs about $200,000 worth of equipment, which would be for things like registers and ovens and freezers and fountains, soda fountains within the establishment itself, as well as the salaries that he expects to pay in the first year, and the owners or business owners' expected sales. So here's some of the 4 fundamentals. And with that information, we'll put together a real quick, simple profit and loss statement, what can be expected in the first year. So based upon $150,000 worth of sales, he estimates there's going to be about 35% will be the cost of goods sold for $52,000, which gives him a net revenue of just under $100,000. Revenue less cost of goods sold is equal to the net revenue. That's the actual monies he has coming into the organization after paying on a marginal basis for the supplies to provide the food or gelato to his customers. In addition, however, there's quite a few other expenses, things like salary, putting down over here for $25,000, rent, $15,000, which the 5% represents the fact that they're going to be assuming that the rent increases over time. Then he's had to borrow that $200,000 or find a provider of the capital who is charging him $20,000 a year for the use of that money for the services associated with the bank in Islamic countries, associated with the bank's extra cost for providing that capital in terms of monitoring the business itself. And finally, there'll be taxes paid, assuming over here at a 20% rate of $7,500. In addition, on a year-to-year basis for that $200,000 worth of equipment, it's on a depreciation schedule of 10 years. So there's a $20,000 charge per year pertaining to the loss of equipment value. So net of all of that, starting off with $150,000 in revenue or sales, the organization expects there to be $10,000 in actual profit that the business owner can expect to make for his activities in the business itself. All good, John?
Very good, very clear.
Okay. The other side of the sheet is to look at, in addition to the profit and loss statement, what the balance statement actually is. And this is simply a recording of the assets that the organization has. So at the time of startup, the organization started with $20,000 in cash on hand and $200,000 in equipment. Since that $200,000 was in fact provided by a third party, it becomes a liability to the organization right before, at the time the business starts, of $200,000, and there's $20,000 worth of shareholder equity. At the end of the first year, however, there's an additional $10,000 that have come in the way of profit. So the shareholder equity will increase by $10,000 to $30,000, and $40,000 of the liabilities will in fact be decreased. So again, all of this right now draws the distinction, because if we're at the end of year one, the numbers that you're seeing over here are the accounting records that look at the past. As I mentioned before, though, financial plans represent the future. So on the next slide, we're going to look at just that. If we were starting off at the beginning of year one, what does the future look like for the organization? What does a business owner think will happen with his company in year one, in year 2, 3, 4, and 5? So we have the same concepts of revenue, cost of goods sold, and various expenses associated with the business on an annual basis, as well as what their balance sheet would look like with respect to assets and liability. In the assumptions that the business owner have over here, he calls for relatively moderate growth in the business over time, a 5% increase in the revenue per year, and a 5% increase in the cost of goods sold and various expenses with the business, except for the depreciation, which is a fixed during the term of the first 10 years. So on the surface of things, it would appear that the business owner has set up for himself a very viable business. making $10,000 in profit the first year, goes up to just shy of $14,000 in the second year, almost $20,000 in the third year, fourth year, and by the fifth year, he gets up to $26,000 a year in actual profit to the organization. And corresponding to that over time, their shareholder equity is increasing from the $20,000 that he initially put into the organization up to over $100,000 by the year 5. So one would think on this on the basis of a simple forecast of the numbers that the financial analysis looks very good. This is a healthy organization. On the surface, that's true. But let's take a look at what happens if there's just an ever so slight change to these numbers. Instead of there being a 5% increase in the revenue and a 5% increase in the expense side, let's move those numbers around over time by just 1%. So let's have a 6% increase in the costs and only a 4% increase in the revenue side, and see how that changes the fundamentals for the business itself. So over here, we're showing where the actual, wait, I have the wrong slide. Ouch. Yep. Yeah, oh, I'm sorry. We're still looking at the same P&L over here with the 5% revenue side and the 5% on the expense side. But what I've added to the slide over here, and I forgot to go through this, is the actual cash flow analysis, which is on the right-hand side over here. Because on the left-hand side, we have the profit and loss statement, which includes concepts such as depreciation of the equipment, $20,000 a year. But the reality of the matter is, from a cash flow perspective, it doesn't utilize any cash flow. What does use cash flow, however, is the payment of that actual loan to the bank of $40,000 a year. As we mentioned at the very beginning, he borrowed for $200,000, and he's paying the bank back over the course of 5 years, which is about a $40,000 cash charge every year. And from a financial planning and from a finance perspective, it's really the cash flow that is often much more important to the viability of a business than the actual profit and loss of the organization itself, because it's much more sensitive in terms of how well the organization will be able to pay the bills. So again, with the business owner's initial assessment over here, where he's starting off with $20,000 in the first year, when he started the business, at the end of year 1, he'll lose half of his cash flow and it'll be down to $10,000. At the end of year 2, it's even a little worse situation where he's going to lose an additional $6,000 in cash and be down to $4,000 in business. And this is very typical for a new business startup, where in the first year, 2 to 3 year time period, that a new business can expect to be consuming, i.e. reducing their stake of cash on hand within the organization. And it's really at years 4 and 5 where the operations and the momentum for the business starts growing, such that there's a positive cash flow to the organization, which is exactly what's shown over here, that in year 4, the net cash flow starts turning positive for him and growing accordingly. Questions? Good.
Oh, it's crystal clear.
Okay.
Year 4, 2051. Year 5, even more money. Good. Beautiful. Beautiful.
So now we'll get to the slide that I was referring to before, which instead of having a 5% increase in the revenue and a 5% increase in the cost, we're going to change those assumptions by as little as 1%, such that the revenue forecast will only be 4% and the cost forecast will be increasing by 6% a year. And then let's see what happens with the business over time. So we have a very different scenario over here. Just that 1% error or 1% change in the revenue forecast and 1% change in the expense forecast causes a tremendous difference in the viability of the business. And that the cash flow for years 1, 2, 3, and 4 now turns negative. And it's not until year 5 that the organization starts to have a minor positive cash flow. More importantly, however, with the numbers that you see in the balance sheet, the initial capital on hand, cash to operate the business, to pay for their expenses on a day-to-day basis, turns negative in year 3, and it stays negative in years 3, 4, and 5. Well, unfortunately for the new business owner over here, what this suggests is that he's very sensitive to his forecast, and that if things don't go almost exactly as he plans, that by year 3, he's not going to have the money to pay his employees, he's not going to have the money to pay his suppliers, and he could very well go out of business by year 3. So this is an example where his initial assumptions that $20,000 in cash on hand is good enough based upon the expected profits from the business, that on a reality basis, unless he has a higher cash infusion either at day 1 or in the early years of the business will most likely go bankrupt by year 3. And this is even though the company, from an accounting point of view, is profitable in each and every year. So you can ask yourself, well, how is it that he's going to go out of business if in fact he's profitable every year? And that gets to the basic difference between an accounting profit and loss statement and an actual cash flow analysis, a cash flow analysis in terms of the sources and uses of the cash. And the big difference, why did it happen? Why did he go bankrupt with just such a small change and have zero cash available in year 3, is that the difference between the accounting and the financing from the cash flow is that the economic life of the depreciation of the financial assets, that equipment he bought, accounting says it has a 10-year economic life. So the profit and loss statement is only assessing him 1/10 of that value each year as an expense item. But on a cash basis, he's agreed to pay the bank back 1/5 of the $200,000 every year on a cash basis. So the P&L only charges $20,000 per year, but the actual cash flow was $40,000 a year, resulting in a $20,000 difference in the actual cash flow for the organization to the negative, which in the example over here by year 3 results in the business going bankrupt. And this distinction between the economic life and the cash expenditure, well, in the example over here, it seems like, well, it's obvious. He should have just taken this into account when he was planning for the business. But it's not as simple as it would appear in the example over here, because the reality of the matter is there's a wide variety of assets that the corporation would have to keep track of, and the differences between the economic life of those assets and the repayment term vary tremendously. Just to give you some examples over here, if as part of the business operation, the owner had to buy land, well, the economic life of the physical land is measured in hundreds of years. You buy it today, you own it today, 50 years from now, that land is still going to exist. 200 years from now, that land is still going to exist. And on a year-over-year basis, most likely that land will be appreciating or increasing in value. But the repayment term, no one is going to offer capital to buy land where they're going to be repaid back in 100, 200, 300 years. Just as my example in terms of borrowing John $100 for 1 minute versus 1 year versus 20 years, he's going to want an ever increasing higher cost for that capital the longer the term of the repayment period actually is, such that on a practical basis, land typically gets paid off on a maximum of 30 years. Structures, different story altogether. Economic life of a structure might be 50 years, such that if you don't do anything to a particular structure after it's constructed, 50 years later, the thing will have deteriorated to such a point that it needs to be torn down. For that reason, the repayment term on most structures are measured on the order of around 20 years. For major equipment, things that would cost, robotics that are going into a factory, steel mills, major transportation equipment. Those types of equipment may have an economic life of 15 years, but typically it'll only be loaned out for 7 years on a repayment basis. For minor equipment, such as things like refrigerators, et cetera, that turn over quickly, it might have an economic life of only 5 years, and the bank's going to require 3 years for the repayment. Computers are even have a shorter lifetime. I think you all know, if you buy a PC today and it has any sort of significant breakage 18 months down the road, you're not going to try to fix it, you're going to replace it outright. And even if it's working very well, 2 years down the road, everyone's replacing their cell phones because the technology has gotten so old, or the viability of the software for it has gotten so antiquated that no longer they'll use it. So the economic life for a computer might be 2 years, but the repayment term only 1 year. Organizations sometimes will also look for capital to help source training for their organization. Well, from one perspective, if you train an individual, they have a lifetime's worth of value that they're going to use that training for. So why is the economic life over only 2 years? Because unfortunately, at least in Western cultures, the expected length of employment with that employee might only be 2 years. So they're getting value from the organization that might last them throughout the rest of their career. But for the organization's point of view, if they only expect that employee to be on board with them for 2 years, the economic life of that training is going to be 2 years. And if you ever try to get a loan for something like training, the banks are going to be looking for a very, very quick repayment on those funds themselves. So what we have over here is some of the trade-off in terms of what we talked about before, and it's really called the yield curve, where providers of the capital, they'll want to be repaid real quickly for lending the money or providing the capital to you. And the longer repayment period, the higher the cost of the capital will be. And you see references in general media, if you listen to any of the business channels, all the time as to what the yield curve is. And this is the typical yield curve, that the longer the time frame of the repayment, the higher the cost will be for that particular loan. You also sometimes hear of the inverted yield curve, and that occurs where in the short term, the interest rates are actually higher than in the long term. And that's because of that happens when the borrowers and lenders expect there to be a recession in the economy itself, that the short-term costs can escalate because the Fed is going to escalate the interest rates higher than normal to try to encourage a recession in the economy. Next, what we'll be talking about very quickly over here, just to review financing, which is the sourcing of capital. Where would this business owner actually get money from that $20,000, or hopefully, given the risk that we saw associated with the business, maybe $40,000 or $50,000. Again, depending upon the organization and the amount that an individual or a company is looking for, there's a wide variety of financial sourcing. For new business startups, for something like a restaurant or a gelato store, probably the primary source of funding would come from the individual's personal savings. Another source might be friends and families, their savings. They might also take on other equity investment partners, private partners. Bank financing, also a source going to the bank. And bank financing can take a number of different routes. One would be where the company explicitly goes to the bank, and on a corporate basis, they look for capital to be provided from the bank. Also, what happens, quite frankly, quite often in the US for small businesses is that new business owners combine the personal aspect with bank financing, such that literally right before they start up a business, take out 3, 4, 5 different credit cards and finance their business on a credit card itself. So they won't get $100,000 worth of capital finance from a bank, but they might find 10 different credit card issuers, which will each give them $10,000 in a credit line on a new credit card, and they'll use that credit line for the next 3 years. A very, very expensive way to fund a business, both from the interest rate which is charged, which for the credit cards would be on the order of maybe 18 to 22% a year, and also very risky in that if the business fails, that business owner is personally liable for the repayment of those credit cards. Another source of funding when there's major equipment involved would be the actual equipment manufacturers themselves. Very, very common on the consumer side, even for the equipment manufacturers. If anybody goes out to buy an automobile, you see at every automobile dealership in the world practically, they'll be offering finance terms for the purchase of that equipment. Well, the same is true for all of the major computer equipment companies, or if you're a Caterpillar tractor, you're making construction equipment. Typically, any major equipment manufacturing company will have financing terms available, which they might be doing within the corporation, or they have special arrangements made with banks to provide financing for their equipment sold. Another source is crowdfunding, especially for small businesses, and this takes on one of two natures. Generically, crowdfunding could mean doing an IPO, going to the publicly traded securities markets and looking to sell shares in your organization. Or online, there is an ever increasing number of crowdfunding sources where rather than having to go through an IPO process where you'd be looking to fund, tens or even hundreds of millions of dollars or billions of dollars, on a crowdfunding, you're looking for tens of thousands of investors, each to provide you anywhere from $100 to $1,000 on a crowdfunding basis. For all of these, there's really no single best source of capital for the business, because the best source of capital is dependent upon balancing the needs of the organization, what their actual amount of the funding is, and what time period they can repay it back, as well as balancing those needs with the requirements of the capital providers themselves. And these needs for each of these sources vary, and what the capital providers are going to be looking for varies. So let's take a look at just to talk about the few that we've talked about over here in terms of what are some of the terms and conditions that would come into play with respect to trying to source your capital. There's 4 general concepts that come into play, and they can be structured in an actual agreement in various fashions. One is whether or not the funding will in fact be secured. By secured, we mean, will the individual be personally liable for the repayment of that loan, or will the business be liable as a whole for the repayment of that loan? Or is the equipment guaranteed by, or rather is the capital guaranteed by the actual equipment themselves? Most sources of capital for equipment in Islamist cultures are secured by the actual equipment. This is similar in the Western cultures in that when a loan is taken out on a major piece of equipment, the bank or the provider of the funding typically will have a lien on that particular equipment, such that if there's a fault on the payment, on one of the monthly payments, the bank or the provider as the capital has the right to go in and repossess the equipment, repossess the building, repossess the computers themselves, and take ownership back of it. In Islamic cultures, the only difference is that there is no repossession process, and that during the term for the capital, the bank typically has the ownership of the asset itself. So if there is any sort of breach, the provider of the capital for the equipment simply stops allowing those pieces of equipment to be utilized. Second component for the sourcing of the capital is the actual cost. Islamic cultures talk about it in terms of the cost that the banker providers will require for the use of their money. Western cultures talk about it as the interest to be paid. Third term that we've talked about already is in fact the term, which is how many years will this thing, when will the capital be repaid? In 1 year, 5 years, 10 years, 20 years, 30 years? And finally, what is the amount itself? Are you talking about a small amount? John's going to lend me $100, or are we looking for $100 million to fund, major plant development? And as you can see in the chart over here, each of these, in terms of what the loans will probably close at, is going to be different based upon the source. So if you're looking from your personal savings, it's really not secured, because you lose it, it's gone. The interest or the cost for it is going to be very low. You're probably not going to charge yourself very much at all. The term is long because you have forever to repay yourself, but the pitfalls or the drawbacks of relying on your personal savings is that it's probably very limited, the amount that you might have available to provide to the business, or the amount that you'd be willing to provide for the business. When you try to get monies for a new business from friends and family, many of the same parameters come in place, but they're probably going to be looking at a much shorter repayment period than you would be looking to repay yourself back with. Similarly, if you look at one thing that's often overlooked is trying to get some financing from customers. They're very much similar to the friends and family. They might not be your personal friend, but they're a friend of the business. So I can talk through each of these, but you can see that depending upon who the source of the capital is, what factors are going to be coming into play with respect to whether or not the funds are going to be secured, what the cost will be, what the term will be, and what the amount will be, varies by the provider. And it also varies depending upon the needs of the business itself, which category of whether or not it's going to be secured, what the cost is, what the term is, and the amount is for the business will differ. In the case of our restaurateur or gelato store, he's looking for relatively short to medium term financing for relatively low amount. So the idea of him trying to issue corporate bonds or crowdfunding or equity investors really isn't part of the mix. He'd be looking primarily for things like personal savings or from friends or from business partners, or realistically, since most of it is going for that refrigeration equipment or possible stoves and ovens, it might be from the equipment manufacturers themselves. If, however, you're automobile manufacturer and you're looking to invest $2 billion over the next 2 years to build a new manufacturing plant for electric vehicles, personal savings, friends, customers, business partners, equipment manufacturers, you'll never be able to get enough money raised from those sources. So they really need to look at things like corporate bonds, bank financing, or equity investors themselves, be it in the stock market or new public shares being issued to secure that level of investment within the organization. So relative to covering the fundamentals of finance, those are the points I wanted to cover. Do another time check over here. We're right at the 1 hour mark now. So John, are there any other questions from folks?
Nothing for the time being, but your presentation is very thorough, very plain, straightforward, and just about everybody and anybody can understand it. Thank you. Thank you so much.
One last point over here, and it was recorded last year because many of the principles of economics apply to finance. So there is an online video from last year that talks about economics, which is really the science and art of understanding business and consumer behavior. The reason I bring this up is that many of the relationships between the costs and the benefits in finance, they're really fundamental applications of economic principles. So understand an overview of the terms for economics. Encourage you to take a look at that video.
Excellent.
Okay.
All right. Well, Mike, that was one of the best presentations we've offered to these students and the friends around the world. I don't know, maybe because I like finance and accounting, maybe because I like numbers, but I thoroughly enjoyed it. But again, the way you presented it, slow, straightforward, with numbers and examples, it was very, very understanding. And thank you. I can't thank you enough. I hope our
Thank you,
audience.
everyone, and have a good evening all.
Okay.